Not a good day for chip stocks. The semis are sinking today following Broadcom earnings and some iPhone demand concerns reported by Nikkei. The VanEck semiconductor ETF down over 1%. Tech broadly, despite the recent weakness, still the best performing sector of the year. The XLK is up over 11% this year, outpacing the broader market. Let's break this all down with Larry Haverty, portfolio manager at LJH Investment, and Jim Paulsen, chief investment strategist at the Leuthold Group. Guys, happy Friday. Good to see you both. Jim, you got a good note today called .com Vu, where you look at basically S&P X Tech. You look at tech ETFs as a percentage of all sector ETFs, and you're basically arguing this rhymes with the .com boom.
Right. Well, it's starting to, Carl. It's not so much, it's not nearly to the same magnitude as we were at 2000. But it's very interesting. The character is very similar. Tech stocks have been outperforming, of course, but you may be surprised for how long. The S&P 500 X-Tech Index, if you exclude technology stocks, relative to the overall S&P, has been underperforming fairly significantly now for 5 years. It really began in 2013, which is precisely the amount of time that the .com episode went on from 1995 to 2000. To give you an idea of magnitude, if you start each cycle in 1995 and 2013 at 1.0, if you will, today X-Tech S&P is down, gone from 1 to under 0.9. Back in the .com era, it went from 1 to under 0.8. But I would argue that means we've had about a half a .com bubble in terms of that. The concentration's been pretty extreme. If you go back over the last 5 years, tech stocks in the S&P have outpaced X-Tech stocks 2 to 1. If you go over the last 3 or 4 years, they've outpaced 3 to 1. If you look at the last year, it's been 4 to 1. And year to date, as you kind of mentioned, tech stocks are up about 15% within the S&P, and X-Tech, you're flat this year. So it's getting quite extreme. And the attitude surrounding it seems similar to the culture that existed in the late 90s, where tech can't lose, and it's a defensive investment against rising yields. And I just wonder if it might end similarly, not to the same magnitude, but somewhat similarly here again.
Although, Larry, the differences in business model maturity, obviously corporate profitability, nowhere near what we saw in the late 90s.
No, that's true, Carl, but there are a lot of warning signals, and I think what Jim said, he's looking at the puzzle from a different angle than I am. But let me give you a couple really juicy points here. First of all, we're getting security issuance. And you had opening the New York Stock Exchange today a SPAC. In the good old days, they were called blind pools. They had billboards on them, an extraordinary investment opportunity, but no one to know what it is. And the guys doing this blind pool looked very happy, public throwing a lot of money at them. Twitter just did a $1 billion convertible, I believe. I used to work in the convertible business 30 years ago. It's the most expensive convertible I've ever seen. I can't understand why the buyers would buy it except for a technical reason. They essentially sold capital at 47 times EBITDA, and not one dime of that $1 billion is going to increase the demand for Twitter services. This is what you saw at the end of a previous tech cycle, and you know from reading the headlines that the regulators are all over these companies now. Facebook's had to hire thousands of people to protect privacy. I think it's just a matter of time until Amazon gets investigated for antitrust. And as a consequence, the margins on these companies, no matter how bullish you are going to be coming down. And one thing you learn is that tech investors don't like margin decline. So not only is there very, very high valuation, but around the fringe, there's warning signs. But on the other hand, these are extraordinarily good businesses. I also am worried about the law of large numbers. There's just so much share in the advertising business that Google and Facebook can take, and they're pretty much, I think, at the limit, and we're going to see a slowing of revenue growth for both of these companies.
But boy, so Larry, are you cutting your exposure to things? And I mean, by the way, we talk about technology, but FANG makes up so much of it, and you can make an argument that Facebook and certainly Alphabet are both companies that have seen their multiples fairly low versus their incredible growth rates and their margins that they've had. Amazon and Netflix a bit different. Apple also has never traded, what, above 17, 18 times. So I'm just curious, Larry, are you selling some of these stocks as a result of what you just shared, or how do you view it?
We only own at the present time Apple and Google, and I'm comfortable with the multiples there, David. And I think your analysis is spot on. I just don't understand the multiple on Netflix. If Netflix goes up 40%, it basically becomes another Time Warner. And as good as the business is, and I don't think it's a particularly good business because they don't generate cash, and you know how I like cash.
Yes.
But eventually, the law of the large numbers is going to get them. Amazon, I think the demon is antitrust. I have very little doubt that someone in Washington is thinking about the Standard Oil model, and I think it's only a matter of time till Amazon's dealing with the Justice Department.
That'll be
so
fascinating.
there are risks in some of the FANGs.
Jim, when I heard you talk about we're only halfway there in the bubble, I thought, oh, we got at least another half to go. I mean, and you know, it's funny because we go back to that time, and I can remember people in 96, 97, 98, 99 all saying, oh my God, it's a bubble, the end is coming. It took a long time.
Yeah, but it's been 5 years in both cases, David. I agree with you. On a performance basis, we're only halfway there, but on a time basis, we've done the full 5 years. That we've reached the 5-year mark, 2013, 2018, when they've really underperformed. I want to respond to the question about what do you do here? And what I find interesting is there's been significant narrowing of participation within the S&P 500 as these FANG stocks have really taken over the marketplace. And so the equal weighted S&P has significantly underperformed. But within the Russell 2000, it has not been the case. It's been outperforming the S&P, and tech stocks are doing well there as well. But what's happening within the Russell is tech stocks are just matching market performance within the last year, rather than significantly outperforming it. Unlike the dot-com in the late 90s, where both small cap and large cap tech stocks were far outperforming the average stock, that's not happening in the small cap universe. But it is happening in the large cap universe. And I think it says something about the risk of the large cap popular ETF invested, retail invested index. And one way to deal with this is to maintain a technology weighting, but do it in small and mid cap stocks as opposed to the popular FANG names.
I feel like bubble's a little strong. I don't know. Isn't the whole difference we're out of time, Jim, but maybe 10 seconds here.
In fairness,
the whole difference, it's not speculative investing?
I don't think you use the B word in your
I never used the word,
I
never used the word bubble. I think the character and attitude of the marketplace, Sarah, is similar. We're giving up on value investing and leaving it relegating it to the dustbin of history. Tech stocks is the only game in town. I think it's similar, but certainly the magnitude is far, far less than what the bubble was in 2000. Doesn't mean we can't have a correction, though, of much smaller proportion than what we experienced in 2000.
Guys, good discussion. We're going to watch it. Larry, Jim, have a good weekend.
Thanks a lot, Jim.
Larry Haverty, Jim Paulsen.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.